This week was a positive week for Canadian banks as they reported better than expected second quarter results. However, it was also a tumultuous week for the markets and investors. For analysis of the week that was and the week that will be, Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital. Hopefully you can hear me, Diana. I know we've had some trouble this morning.
Yeah, I can hear you a little bit.
Okay, just talking about the week that was, quite frankly, versus last Friday, the markets are up. Kind of wild week. What did you make of this week?
Francis, I didn't, we can talk about fundamentals and share our views on fundamentals and so forth. Talk about the growth trade or talk about the record outflows of cash that we've seen as reported by Lipper funds. But let's put on our trading hats. And what I'm going to say as a bottom line sentence is passive strategies lead to passive trading, and passive trading is not passive pricing in a downward market. A lot of people are talking about price insensitivity, and with the way technology has brought our markets, a new market structure, regulation, altogether act to increase the volatility whenever there is a direction change, in this case, the downside. And we've seen on Monday, futures were down, limit on the open, hedgers could not get their hedges out, spilled over into the larger caps, and there's all kinds of commentary going on about sophisticated strategies, volatility funds. Who knows what is a volatility neutral fund and what it actually means from an operational perspective. When volatility jumps, these guys have to do things, reduce their equities. There's lots of these quant strategies and sophisticated asset managers or driven strategies that have nothing to do with fundamentals. And so we've seen our stocks that may fundamentally have nothing wrong with them, instead of opening down 3% because we have a growth issue or a growth conversation going on, they're opening down 10 and 12% because of insensitive pricing.
So, Diana, let's go to the heart of this. What does this do for confidence for, and I said this in my morning note, for a guy or a gal who wants to buy good companies at good prices? Maybe those are passive strategies, but confidence is going to be eroded if these kinds of things can continue to happen. They're not big amounts of capital, but they punch above their weight.
Right. Francis, I hope I heard you correctly because I hear you very poorly. I'm going to try and answer, and if I'm not answering correctly, my apologies. Passive strategies have been sold as being really great, say, ETF strategies that, just buy the ETFs, don't go into an asset manager that markets or that trades your portfolio actively. But, in reality, what professional asset managers do is watch for these pockets, take advantage of dislocations such as this. So you get an advantage of a person sitting and watching your money all day long as opposed to a computer with a mandate. So there is room for all of these new products in portfolios, but humans are not as productive as they can be without technology. And technology without a human is not smart. So the balance is the right thing. And, if you want to have a passive strategy, for example, a lot of asset managers, they utilize ETF products and utilize hedging products to manage a wholesome portfolio, which takes advantage of, say, buying that favorite bank, or if you think that the fundamentals have not changed.
Well, let's talk about the banks. Up until the beginning of this week, they were down pretty significantly. They have recovered. Were you taking advantage of the weakness and adding to positions or initiating? And would you do some more on the Canadian banks? Is that where you want to be?
I honestly, in the big picture, I can't say anything bad about this earnings season in the Canadian banks. Yes, there are pockets of weakness in, say, some oil and gas portfolios that have sort of lightly been mentioned, offset by stronger segments, fee income, which comes out of the consumer pocket. But generally, there have been fantastic earnings in light of expectations that perhaps we're going to see some softness. And you know how we talk about short Canada theme from the international community? Well, one trader called it today cover Canada theme. So there's a lot of short covering. Do you invest in the Canadian banks? We have a choice. We choose to expose our Canadian financial exposure into the insurecos and asset managers. They have the same thematic movers, but higher growth. And from a pure bank perspective, we prefer the U.S. banks. From a total return perspective, we feel the economy faces less headwinds than here. Even if it doesn't work out, if the U.S. grows, or if the U.S. is indeed the cleanest shirt in the laundry, and it does grow properly or slowly and in a stable way, Canada will benefit as well. But from a total return perspective, dividend growth, cost cutting, a lot of the regulatory issues behind them. So from a total growth perspective, we feel the U.S. banks are more attractive, even though the Canadian bank earnings season has been fantastic.
And just briefly, Diana, more volatility next week like we had this week, or is it done?
I do think that we're in for volatility until September's FOMC. Possibly till the next earnings season. I am not very bearish on the market, but I do think that the volatility does shake out some things, and we do have to be mindful of hedging. I think that the U.S. rate narrative, whether there is growth and whether they are able to do that first lift off of rates in the normalization context is important, and it needs to be sort of proven to the market that the U.S. is in a solid footing and globally as well. And then we're going to need some earnings season to further prove that that is indeed the case and has not been a policy mistake. So I think we're in for a volatile period.
Diana Avigdor, thank you very much, joining us from the TSX. She's at Barometer Capital Management.